Perfect. Good afternoon, good evening, everyone. So my name is Tim Creed, and I head up the private equity investments, or all of our private equity investments at Schroder's Capital. And I'm going to talk about why private equity should be in your portfolio. There was a nice slide earlier on that suggested that 20% of a portfolio should now be in private equity. And so I'm going to give you some points about why that should be the case, what are the strengths, what are the reasons for success, etc. And so with that, if we go on to the agenda side, I'm going to cover three topics. The first topic is what is private equity and why should I invest? The second topic is a little story about Schroder's capital experience and where do we invest? And the third is different ways of investing for investors. So if we start with the first topic of what is it and why should I invest? The first comment to make is shown on a slide which has a nice number of logos, and it really just shows you in 2 slides time why private equity is everywhere. So if we go on to the next slide, it shows that the two parts of private equity are the world of what's called buyout investments and the world of venture capital investments. And these, I would say, are just some of the logos from our past or our existing portfolio. So buyout investments, as was described briefly earlier on, this is a way of buying a whole company. So most of these investments, when we and our partners bought into these companies, we bought between 50 and 100% of these companies. We owned them for 3 to 5 to 7 to 10 years, and we grew them substantially during our ownership. I've deliberately chosen logos that are very easily recognized. So most of these are a bit more retail focused, a bit more consumer focused, but I would like to emphasize that private equity actually covers the full spectrum of investments. And so, for example, I chose one called Grant & Stone that you may not know about, which is a building merchants company. I would also like to say across the buyout market that if you look at the UK SMEs, so that's small to medium-sized enterprises across the UK, 21% of all people employed in a UK SME actually work for a private equity-owned SME. So really, private equity is everywhere. On the right-hand side of this page, I show venture capital. Again, these are some of our investments. Here I went global rather than just UK. And they're clearly companies that most people would recognize. I think most people know about Google and Facebook and Tesla, etc. The key to these venture capital investments, though, is to access these companies in the seed round or the Series A or Series B round when the companies are at quite low valuations and are still being grown. And that way you get a very large capital gain if the companies are successful. And in most cases, these companies are then sold via or exited via an IPO, or sometimes they're sold on to other trade companies, other trade buyers. The next slide shows the company life cycle. And this is a rather simplistic story because I must say most companies don't follow this entire journey, or rather we hope many of them don't because it ends in restructuring. But many kind of, if you think of the aggregate journey of companies in aggregate, they do often follow this. So the first part is company creation. There was a picture earlier on of Amazon and in his kind of studio office with just the word Amazon.com on the wall. Many companies start with 1, 2, 3, 5 people in a garage or kind of in a location. So Google, for example, started with 2 people in a garage. Companies are then created. They're they're backed by venture capital groups or other sources, and then they are grown quite significantly over time. The most successful venture companies will then often get some form of growth round and a growth financing from a growth capital investor. And then they can also go into maturity where they can go into a buyout investment, so owned by private equity. Of course, the journey of a company can go for continued growth, but some also then go into decline and into turnaround, which would then be turnaround. And at the bottom of this page, what we've shown is private equity covers the full life cycle, effectively from beginning to kind of ongoing growth. So if there is a problem, it can then help the companies get through that problem. Whereas public equity ownership generally only covers the very late stage venture, a bit of the mature companies and some of the companies that decline. It can cover some that recover as well, but that's a very small number. So really private equity covers the full landscape, the full life cycle of a company rather than just a narrow field. If we go on to the next slide, we'll have a bit of a picture as to what's happening in the public markets and why private equity, or part of the reason why private equity has grown. So if you go to the next slide, we'll see the number of companies that are in public ownership. So on the left-hand side, this is a chart that shows total number of companies in the US, which is the dark line, and in the UK, which is the dark line, and in the US, which is the light line. Now, a lot of people see that the number of public companies has been reducing year on year for the last 30, 40, 50 years and think that might be because of private equity. Actually, the main reason for the reduction in number of public companies is because they keep on merging with each other. That one public company acquires another company, another public company. And so the total number of public companies out there in the UK and in Europe and in the US has been decreasing over time. If you look and compare that to the private side, in the private side, we have a picture on the right-hand side that shows the number of private companies versus public companies. And here you see 450,000 private companies as opposed to kind of a few thousand public companies. Now, I would like to emphasize, of course, that all these private companies are not necessarily available for private equity ownership. Some private companies will stay in private ownership, so for example, family ownership, for many years and many generations even. But what we do find is many of these private companies do go through some form of change and ownership change and private equity ownership at some point in their evolution and their existence. Now, no story about private equity would be complete without a couple of slides on performance. So this slide really shows the overall performance of our portfolio versus the public markets versus the MSCI World on the left-hand side. And you see here that obviously we've significantly outperformed the public markets, but also on the right-hand side, we want to emphasize that there's lower volatility and also that there is pretty low correlation to the public markets. I'll now move on to a slide which kind of shows the performance in a bit more detail. This is the slide that we often call as the everything in one slide. So effectively, all of these bar charts are the aggregation of everything we've ever done. So this is venture capital, venture capital, growth capital, and buyout. It is Europe, US, Asia. It is what's called primary fund investing, secondary investing, co-investments, and direct investments. And what we've done here is all the investments we did in one specific year, we show the performance today of those investments. So for example, if you look at all the investments we did in the calendar year 2012, they sit today at a 20.9% IRR. And I deliberately chose that because the aggregate performance across all of this 10-year period is 21% net IRR of all of our investments, the good, the bad, the ugly, everything. That's why we call it the everything in one slide. 21% net IRR over the last 10 years. And that 21% net IRR is about 8% outperformance compared to public markets. And there's a comment on the realized direct and co-investments, which I'll come to on a later slide, because I think that really brings to life how private equity talks about itself. Now, with the next slide, I'd like to talk about some potential misconceptions or some views about private equity that I'd like to kind of discuss and elaborate upon. So I've put here 5 misconceptions. This is perhaps a bit of a bold commentary, but these are 5 things that we often hear from people about private equity, where I would like to maybe add some color and some light to it. So the first misconception is that private equity is high risk and highly volatile. Here I would say, if you were to look at making one individual company investment, particularly if it was a venture investment, then I would agree that is very, very high risk and it could be very high volatility. We have venture capital investments where we have made 100 or 200 or even 300 times our money. So we have one, for example, last year that we sold on the stock market. We had put 1 million into it and we got 100 million back. So there are some that are very, very volatile. We have other venture investments that we've lost all the money on. But if you look at private equity and venture capital as an aggregate, if you look at it as a way of pooling the investments by working with a professional institutional manager who can aggregate many deals at once. So for example, put a fund together with many venture investments or many direct investments or many fund investments, then you actually see the low risk and low volatility, which I showed earlier, which is kind of very consistent performance year on year. The second topic is fees. This is often a bit of an elephant in the room. When people talk about private equity, they talk about 2 and 20, which obviously are pretty high fees. But what I would like to highlight is private equity through the institutional landscape has a very fixed structure of 10-year limited partnerships. What we're starting to see is something that we and many other people call democratization of private equity. And this is the kind of enabling more people to access private equity directly. And one of the common ways is through investment trusts. And some were shown earlier on in this presentation by by AJ Bell, and also I'll show a couple later. Many of these investment trusts actually have a much lower fee setup And that enables investors to access private equity at a much lower fee level that are very comparable to other normal equity funds. The third topic is lack of transparency. Now here I must admit I can see why many people say this, and I think this is an area where private equity still needs more work to do. I would say that if you are looking into private equity, there is still more transparency that can happen. Private equity needs to talk about itself more. Private equity needs to be known for the successful investments and not just for the odd one or two that don't work. So more work can be done on transparency. But what I would say is if you're actually within the private equity landscape, if you work within private equity, you actually have far more transparency than almost any asset class. So when, for example, we look at making an investment, we spend not just hours or days, but many, many days over many, many years working with a management team. We spend time with them. We build out an investment case and a business case together. And what's more, we build it out with forward plans. We help identify add-on acquisitions together. So when the management team says that they will aim to deliver a certain set of numbers in 3 months, 12 months, 24 months, we see what those projections are. We work on those together, and then we can hold those management teams accountable. Rather than if you're looking just at the public markets, it has to be a bit more backward looking, or there's various different rules and restrictions about transparency on the public markets that we don't have on the private side. The fourth point is that a lot of people, when they talk about private equity, they think it's about listing and IPOs, or they think it's about take privates. And I've given two examples here. I'd like to address these two in two different ways. So with regard to listings and IPOs, I showed on my first slide lots of logos. The reality is that about 80% of all private equity investments are actually buyout investments rather than venture investments. Furthermore, if you look at the successful exits of private equity, so this is buyouts and venture capital, less than 1 or 2% of all successful exits are actually an IPO. And therefore, the way that most private equity companies are sold is we sell the companies that we own either to trade buyers, to families, to corporates, or to other investment firms. We very rarely exit a company by an IPO. Of course, we have many successful ones. Darktrace, for example, was a recent very successful IPO, and we hope to see other successful IPOs in the future. But I want to emphasize that most exits made within private equity are actually not by IPOs. And that's really important when you look at a fund manager and you look at how a firm builds out its strategy in venture capital and buyout investing. The other part of this point, number 4, is about take privates. There are actually very, very few take privates that happen. I realize that at this moment, if you during the course of 2021, barely a week or a month goes past and you don't pick up the newspaper and see something about a take private, but actually that's a very small number of transactions compared to the total number of transactions that happen per year. So you might see a few, maybe a handful, maybe a dozen take privates in a year, and that would compare to hundreds and literally hundreds of private equity investments. So the take privates are a very small proportion of the total number of private equity transactions. The final area I'd like to cover is the topic that some people would view that private equity is about cost cutting. Actually, what we see, having done this for the last 25 years and worked with many other investors in private equity is almost exclusively about growth. We will make far more money by growing a company than we can ever do by cutting it up and selling pieces off. In fact, actually, if you look at employment numbers, for example, employment numbers of UK-backed private equity companies grew about 5 times faster than employee numbers of non-private equity backed companies. So private equity is really about growth of both revenues, earnings, and also about the employee number growth. And so I think with this, what I'll do is I'll move from these preconceptions. So if we jump onto slide number 10, and we'll move into what we do at Schroder's, and then we'll move on to slide number 11, which shows us in a bit more detail. So slide 11 shows performance again, because as I say, no private equity presentation would be valid without performance. But what we've done here is we've shown our quarterly performance. So this is our portfolio, this is our performance on an entire portfolio basis as revalued every quarter. One of the comments at the beginning was about valuation. Private equity values on a quarterly basis rather than a daily basis. Now there's some pros and cons around that, but what we see here is across the last 10 years, we've had 3 quarters over this entire time period where we had small down valuation in aggregate. We, of course, had one big down valuation, and we certainly don't hide away from that. That was in Q1 2020. But what's been really interesting is the real rebound since then. And if you look at the pandemic period, you can look at the quarterly performance that we've been delivering for the last 4 quarters. And actually, the Q2 numbers are also out at the moment, and so they're similar numbers. And what you see is they are so very high, and we think they're high for 2 reasons. The first is, as a philosophy, we and many other investors in private equity like to back companies of the future. We look at business models of tomorrow. We are long-term investors. We invest for 3 to 5 to 7 years. And so there are many companies in our portfolio that we invested in over the last years that we thought would take maybe 3, 5, or 7 years to grow into their potential. What we saw in the pandemic is the pandemic changed many things, and many of our companies actually had 5 years growth worth in 1 year, and effectively their growth was really enhanced. And I'll give a couple of examples of why that's the case in our portfolio, maybe more in some other portfolios. The second reason why the performance has been so strong is that we've been able to buy into companies at times when other people don't necessarily want to buy in. Private equity, we negotiate the timing and we can negotiate the price of the investments that we make. And so we've been very heavily investing in this last 18 to 18 months or so during and post the pandemic period. On the right-hand side, I've got a couple of numbers, and often private equity is, people ask to distill private equity down to 1 or 2 numbers. The easiest way to do this is to look at the performance of direct investments and co-investments, and this is a small subset of our portfolio, so I wouldn't want people to think that this is our entire portfolio. This is a small subset. We have made 147 direct investments into companies. We have sold or realized 39 of those. And those 39 realizations have delivered 31% IRR and 3.4 times. Now that I see we moved on to the industry focus, we as an organization, as a Schroder's Capital private equity platform, focus on 5 industries. And in fact, actually, I'd say that we focus mostly on the first 2. So about 30% of our portfolio is healthcare, 30% is technology. So 60% are the industries that have really been the most beneficial, the industries that have benefited the most from the last 18 months of change and dynamics. We also do consumer and business services and industrials, but they're often very much tech-enabled businesses within those sectors. What you see here is there's no oil and gas, there's no commodities, there's no big banks, there's no big insurance companies. People can access those companies through the public markets. What we find in private equity is we don't do the companies that are often referred to as the sin stocks, such as the weapons and tobacco, etc. We focus on the companies that we feel are going to be really dynamic and growing over the next few years and really sought after at the point when we want to exit in maybe 3, 5, or 7 years' time. Now, if I go through maybe just looking at time, I think what I'll do is I'll actually skip the next 2 slides and I'll talk directly about slides 15 and 16, which is how you can invest in private equity, just to make sure that we have enough time for questions for all the panelists. So slide 16 shows the 2 investment trusts that we run. They're shown at the bottom. The first is called Schroder UK Public Private Trust, and the second is called Schroder British Opportunities Trust. What we also show is the new investments we've put in, the new private equity and venture capital and growth capital investments we put in to each of those 2 trusts during the course of this year. And you see that the new investments we've made fall into these 3 categories of growth, late stage buyout, and buyout. I probably should say a few more words about these 2 trusts, especially considering Mr. Woodford's picture was put on 2 of the presentations earlier. So the Schroder UK Public Private Trust was actually one of the vehicles that he used to run. And so when there was lots of problems there, we decided, or the board of that investment trust ran a process to find a new manager. Many firms bid for it. We as Schroders bid for it, and we were selected to take over that trust. Now, we have had to do a lot of work to fix that trust, and I definitely don't want anyone to think that's been an easy journey. It's taken us now some 18 months to work through the portfolio companies in that trust. We've sold off many companies individually. We have had a couple of successful stories. We IPO'd Immunocore in February. We also had a company called Kymab, which we sold, where we made effectively 10 times our money on that investment. And hopefully in the coming weeks, you'll have seen that one of the other companies in that trust is called Oxford Nanopore. And if you read the newspapers, then there's a lot of speculation about Oxford Nanopore itself going for an IPO in the coming weeks. So Schroder UK Public-Private Trust has had, we've done a lot of work to it to get it into the direction that we would like. And we're really pleased to say that we've now made 2 investments, first into Tessian and then into Revolut. And the portfolio itself is about 80-20 private to public. The second investment trust that we run is one that we launched as an IPO in December last year. So we've only been running this investment trust, the Schroder British Opportunities Trust, for about 9 months. This vehicle has a strategy of 50-50 public-private, and here you see that we've already made 6 investments. What I'd like to highlight is we really look at these 2 trusts as very complementary to each other, and we see that what we're trying to do is build out some really high-quality companies into each. So Revolut, for example, we believe is the single greatest fintech company in the UK. In fact, if any of you read the Times article sometime last week, they listed the top 20 fintech companies, and Revolut was smack there at number 1. Interestingly, Rapid was also a top 5 fintech company, and that is in our other investment trust, SBO. What I'd like to say is many people have heard of Revolut, very few people have heard of Rapid. We're equally excited about both companies. They cover slightly different areas of the fintech space. And so what we've now done is we've now made a number of investments. We are actively making further investments, and we'll make further investments across each of these 3 strategies of growth, late stage, and then buyout. And what I'd like to highlight is some of the structural elements that allows us to get access to companies across this full spectrum. So a couple of these companies, I mentioned that maybe 2 or 3% of all venture and private equity companies will go for an IPO. And there are a couple of these companies that we might exit via an IPO, such as Graphcore. That might well be IPO'd at some point in the future, maybe even Rapid, and maybe Revolut. But most of the companies that we own are more likely to be sold to trade, to families, or to other private equity firms. And so when you're looking at getting access to these companies, you really need to be ingrained in both the public markets, so you can see the companies that might go down an IPO path, but you have to be really ingrained in the private markets. And this is where we found that it's really important to have a very large, sizable private equity team who are present looking for deals across the private equity landscape, because this allows us to invest across the full kind of company life cycle. If I go back to one of the very first slide I had, we're able to invest across the full company life cycle from early stage startup through growth, through buyout. And we actually do turnaround, but we don't do it in these trusts because we don't feel that turnaround is the right kind of strategy for an investment trust structure. So with that, I think I'll try to finish exactly on the designated time, and I'll hand it back to Dan for managing the questions.